Now, like you say, we're going to be waiting for that next announcement on tariffs on the 2nd of April. But for now, it really is the case that this noise around tariffs is the key driver. It's very unpredictable. Positive news that tariffs might be less than expected boosts equity markets, helps economically sensitive currencies like the Aussie, like the euro, like the pound, and news that's more negative, larger tariffs, see equity markets lower and sees those currencies weaken as well.
This is Converge,
a podcast from Canberra.
Come with us as we shape the future of finance.
Hello and welcome back to the Converge Market Update. It's March 26th and we're less than a week away from Trump's so-called Liberation Day, where reciprocal tariffs will be announced. The tariff noise to signal ratio remains high, as we know. Financial markets are on edge and currencies appear to be in a bit of a holding pattern for now. I'm George Vessey and I'm pleased to say we've got Stephen Dooley, our Head of Market Insights, joining us today. Steve, great to have you on. Lots to talk about as usual, but I think the obvious focus is the tariff developments because they continue to drive the agenda really, right? What can you tell us?
Yeah, absolutely, George. Very much as we've seen for the last 3 or 4 months, that news around tariffs have driven the waxing and waning of financial markets. And that's been the theme again this week, with markets mostly higher. Really after President Donald Trump said at the start of the week, he offered some relief on tariffs. He said he plans to announce reciprocal tariffs, like he said, on the 2nd of April, Liberation Day. But during the press conference, just after that cabinet meeting, he also suggested the potential for some exemptions for countries, saying, I may give a lot of countries breaks. So that was what saw markets push a little bit higher on the back of hopes that maybe these reciprocal tariffs won't be as onerous as we initially expected. And that's helped US equities in particular have a stronger week. Now, like you say, we're going to be waiting for that next announcement on tariffs on the 2nd of April. But for now, it really is the case that this noise around tariffs is the key driver. It's very unpredictable. Positive news that tariffs might be less than expected boosts equity markets, helps economically sensitive currencies like the Aussie, like the euro, like the pound, and news that's more negative, larger tariffs, see equity markets lower and sees those currencies weaken as well. So very difficult to be able to predict, forecast, or manage financial markets because very unpredictable what we're going to hear from the Trump administration next.
Yeah, I guess, like many policy processes under Trump, the situation remains fluid and no decision is final until he announces it. So this uncertainty is probably going to keep markets on edge, as you say. But it's also important for consumers and businesses, this uncertainty. So in terms of the economic data that we've had recently, anything major to report on over the last week or so?
Look, the data is still mixed, but it is overall trending lower, particularly in the US that we've seen over the last month and a half. And some of the indexes that you use to track economic data, for example, the Citigroup Economic Surprise Index has been continuing to trend lower, particularly in the US. But not single-mindedly negative. It has been more mixed. I mean, in terms of this week, particularly in foreign exchange markets, what tends to be most watched is those PMI numbers, the Purchasing Manager Index numbers. They're seen as the most up-to-date reading of the global economy. They survey these purchasing managers that are making decisions in terms of buying goods or sourcing services. And so this tends to be the most sensitive to expectations, the most up-to-date reading. And so that's overall been more mixed this week, and it's also been mixed in different ways. So in Europe, which of course had seen manufacturing really plumb depths over the last 2 years, we've actually seen manufacturing starting to improve versus expectations, while services, which have been really the only bright light in Europe, has started to slow. So a bit of a change in the mix from Europe. In the UK and the US, it's been the other way around, with manufacturing underperforming versus expectations, while services have actually done a little bit better. So again, that just really illustrates that there's not this consistent theme. It's that theme again of uncertainty. I suppose we shouldn't be surprised that uncertainty from the policy-making sphere is translating into uncertainty around the economic data that we're seeing as well. But even with that data we've seen from the PMI over the last week or so, in general, you break down economies and the global economies into two sections, manufacturing and services. And we're still seeing manufacturing really underperform, and we're still seeing services driving most of the global growth.
Yeah, exactly. I think here in the UK as well, services industries account for 80% of GDP here. So although, like you say, we've seen a downturn in manufacturing here, the services industry is still propping up the UK economy, which is in kind of stagnation mode at the moment. But how is this translating to central banks as well, Steve? We've had a few meetings since we last spoke, including the Bank of England, the Fed, Bank of Japan. What are your thoughts on the monetary policy outlooks here?
Yeah, so I don't want to labour the theme too much here, but again, central banks, just like businesses, just like economists, dealing with uncertainty at the moment. And of course, the way they're managing that is by not really making any decisions. They're on hold. The Fed announced interest rates would stay in the current range between 4.25 and 4.5%. So they're on hold. They want to see some more clarity around the US economy. And you can see that this uncertainty is reflected in the shift in forecasts that we got at the meeting. So US economic growth was lowered. The forecast was originally 2.1%. It's been lowered to 1.7%. So the Fed less confident of US economic growth. But importantly, they've also started to raise their inflation forecasts. They raised their forecast for 2025 from 2.5 to 2.7. So you can see that this is slowly translating into what's a more negative outlook for the Fed. Lower growth and higher inflation is a difficult situation for central banks to deal with, because they can't really cut rates to boost growth, because that runs the risk of accelerating inflation. So we can see why the Fed at the moment isn't moving. They're on hold because they just need more clarity. But at the moment, the way the US economy is turning is certainly more tricky, more difficult for the Federal Reserve. That said, that wasn't what markets focused on out of the Fed decision. What they really focused on was that Jerome Powell said that recession risks for the US were not high. Powell said that in general, you're always around about a 25% chance of recession. And he says that at the moment, in terms of the data the Fed's seen, it's not particularly much more higher than that. So that's why we saw markets more positive, not because what the Fed said on interest rates, but really Powell's expectations around global or US growth. Otherwise, like you said, the Bank of England and again, another central bank that wasn't really willing to make a move, kept interest rates on hold at 4.5. But I think it was probably signal that they were a little bit more concerned about inflation than they had been previously. There was that 8-1 vote, which was a little bit more in favour of keeping rates on hold. That was a little bit more that signaled a little bit more concern about inflation than perhaps the markets had previously thought. I know today we got a weaker than expected UK inflation number, but of course, a week earlier when the Bank of England made that decision, they're increasingly concerned about the impact of tariffs and the impact of higher inflation. And then finally, the Bank of Japan kept interest rates on hold. But again, what we're seeing from the Bank of Japan is they're a little less confident on their previous view. Previously, they were planning to hike interest rates, but now they've just stepped back a little bit from that. We've seen the yen weaken as a result, but all the theme from central banks over the last week or so is that they're a little less confident, they're a little less certain, they're just a little more unsure about what the future holds.
Yeah, as ever, monetary policy, any kind of divergences we see here, integral for FX trends as well. But we're getting the mixed signals from these central banks, but also, as you mentioned, from the economic data as well, and particular economic and growth indicators too, like copper prices, consumer confidence. What can you tell us about these?
Well, this is probably my favourite takeaway for the week that illustrates the uncertainty in financial markets at the moment, because two good rules of thumb in terms of measuring growth. One is that the US consumer is the engine of global growth, and US consumer confidence fell to a 4-year low during the week. Particularly, they're worried about inflation. They're worried about the impact of tariffs on inflation. They're also particularly worried about the expectations for growth in equity markets and bond markets. And that's because we've probably seen a lot more volatility in financial markets as those markets try to grapple with what the future looks like under a more aggressive tariff regime. So if you look at that data, you'd say the outlook looks more negative. Historically, consumer confidence is a good leading indicator of economic growth. On the other hand, one of the other shortcuts in financial analysis is to look at copper. Now, the old joke in financial markets is that copper's the only metal with a PhD in economics. And the reason people say that is because it is very sensitive to expectations for global demand. You need copper in nearly everything from electric cars to housing to power generation. So when copper starts to rise higher, it's normally a sign of improving economic growth. Now, in the US, copper hit an all-time high this week. It's not quite that strong in out of London. It's about 8% below the all-time highs. But this has partly been driven by tariffs because, of course, the US administration has threatened tariffs on copper. But even so, copper wouldn't be at an all-time high just because of tariffs. And it has been trending higher for the last 2 years. So from that perspective, copper's telling us that the future's potentially never been brighter for global economic growth. So really, it just illustrates just the uncertainty in markets, that two of the most long-lasting rules of thumb, US consumer confidence, copper price, moving in absolutely different directions. And yes, you can justify those moves in a couple of different reasons, but it's still a clear sign that one of the oldest and most tried and tested metrics of measuring sentiment and the future are moving in completely opposite directions at the moment.
Yeah, interesting. I wonder if that historically strong positive correlation between copper prices and pro-cyclical currencies start to realign as a result as well, particularly if this tariff noise starts to simmer down. So on that note, finally, how is this all translating into what we're seeing in the movements in FX markets, Steve?
Well, it has actually been a relatively quiet couple of weeks in FX markets. The US dollar up moderately over the last fortnight. That's probably mostly been driven by that Fed decision that we were talking about earlier. That higher inflation forecast means that the Fed probably has less room to cut interest rates. So that's probably been the main story driving the US dollar higher. That said, the US dollar does look to have formed a bit of a short-term bottom. It reached 5-month lows over the course of March, kind of paused around those levels and started lifting a little bit higher. Some of the momentum indicators that technical analysts look at, like the relative strength index, have reversed higher from oversold stretch levels. So the US dollar, after a big plunge so far in 2025, does look to have formed a bit of a bottom and has started to climb higher. In terms of other markets, the euro probably faced the biggest losses as a result of that US dollar comeback. Of course, the euro had the biggest rally. The euro had a massive move throughout end of February, start of March, going from 101 up to close to 110. It's given some of that back now, down from 110 down to below 108. It's down about 2% from the high. So the euro probably the underperformer over the last couple of weeks. Pound, as you'd know, held up a little bit better. That Bank of England decisions provided some support. But for now, market's really looking at that 130 level in the British pound US dollar pair. Bit of a short-term cap up at those levels. Dollar CAD, probably the Canadian dollar, is probably the most interesting market at the moment. The US dollar is at the lowest level in a month versus the Canadian dollar. And that tariff panic that we saw at the end of January, start of February, looks to have eased. Dollar CAD's down 4% from the February highs. So that's been one of the more sensitive to tariff worries in the last month or so. It's really fallen from those previous highs around that tariff panic that we mentioned. Then lastly, in the Aussie US dollar pair, one that's close to my heart, trapped in a range now really between 62 and 64. Like you said previously about that copper price, normally the copper price is a good indication of what might happen to the Aussie dollar, but we're at polar opposites here. The US copper price at all-time highs, the Aussie dollar at close to a 5-year low. So that relationship, that correlation has completely broken down. The Aussie's been, as I say, stuck between that range between 62 and 64. We've got an election here in Australia, so maybe that might inject some action into the pair over the next few weeks.
Awesome. Thanks, Steve. Hopefully we'll see a breakout of this holding pattern over the coming weeks or so. Cheers for the valuable insight as usual. We'll check back here in a couple of weeks where no doubt we'll be discussing the tariff man again and the impact that he has on global financial markets. Thanks again, Steve. See you next time.
Thanks, George. Have a good one.